Everyone, welcome to this webinar with Asian Investor and IHS Markit. I'm delighted to be here hosting this for you. My name is Andrew Crook. I look after strategy and content with Asian Investor. And the focus today is on early warning signals and planning portfolio in what is clearly a new era for everybody in the investment landscape. Doing this specifically using data and how to turn relevant, usable data into actionable insights is the key in being able to identify those early warning signals and act on them. So that's the focus of the conversation over the next hour. So I'm delighted that you all joined us. Thank you for your time. Thanks so much also to IHS Markit, who's co-hosting this with us, and to our various expert speakers who I'm about to introduce you to. So a couple of very brief housekeeping comments. We will have an on-demand version, so you'll certainly be able to re-listen to this and share it with colleagues who are unable to join live. There's also the opportunity throughout the session to ask questions. So there is on the platform, you will see a Q&A segment. Feel free to type in questions throughout the session. And when the moment is right, we will ask those to the speakers. They very much want to hear what you've got to say, so please do tell us what you want to know. We also will do some audience polling, so I'll ask a few questions during the session where we are keen to get your perspective so we can gauge what your views are, and again, the speakers can then share their perspectives on that. So, sit back and hopefully enjoy some really interesting insights and get some key takeaways over the next 55 minutes to an hour. So let's get started. I'd like each of the speakers to give a brief introduction. And maybe when you do, and Tim, I'll start with you, maybe just briefly introduce yourself, your key area of focus, and a very high-level general comment on obviously what the challenges are now in this current environment in assessing the various macro and market trends to direct what you invest in. So Tim, over to you.
Thanks, Andrew. Morning, everyone, and thanks for having me on today. So my name's Tim Reardon, representing Aware Super, which is one of the larger Australian pension or super funds. We have 140 billion in members' funds, and so keen to share some observations from an asset owner perspective. So my role at Aware is as a portfolio manager of our internal fundamental equities team. I guess, Andrew, from a technology perspective, I think broadly the acceleration in adoption of technology is probably the key focus for us, and that the awareness of that, I guess it just means that we're seeing everything move faster. So, you know, whether it's news flow, data collection, availability, the reflection of that in financial markets, and how we see our investee companies, their business models evolving, probably faster than we have in the past. So I can explore some more of that as we talk.
That's great. Thanks so much. Desmond.
Hi. Thanks for having me on today. My name is Desmond, and I'm the portfolio manager in Cornings, which here in Asia, we focus on multi-asset strategies for our institutional clients. Today's topic of warning signal is actually very interesting to us because we have been building, using, and modifying a lot of our core models for many years for our investment process. And I guess the biggest challenge to us is always, and probably not too much difference from other users, is what kind of data to use, how to use the data properly, and are we actually using too much or too few data before jumping into conclusions. So hopefully we can get a lot of insight from today's seminar.
Great, thanks, Desmond. Andy, how about from your perspective? You come at it from a slightly different angle to Tim and Desmond.
Exactly, yes. Hi, thanks for being on the call. I'm an NEG from Bluefire, so I'm speaking from a point of view of a fintech. So we're a young company. We started 4 or 5 years ago, depending, what the milestones you're looking at. Trying to do on a very high level is just systemizing a human decision-making process pertaining to investment. Essentially, that's what we do. And speaking of the current challenges, I guess, speaking of COVID in particular, I think that just a generic challenge for us from AI and data perspective, because structural breaks is always some kind of headwinds to us to have a reasonable sized data set to work on. And COVID again proves the challenge here.
That's great. Thanks to the three of you. I know you've got lots to share over the course of this discussion. And again, just a reminder, whenever you think of a question later on for you in the audience, please ask any of those speakers. So Ross, I've deliberately left you till last. Thanks so much for joining us today, because you're going to take us through sort of a practical use case of how and why data is central to investment returns and risks in today's era. So over to you for the next few moments, Ross.
Thanks, Andrew, and for everyone joining the webinar today. So, as Andrew mentioned, I'm Ross Allen. I come from IHS Markit within our financial services division. And I've spent a lot of my career looking at data and how to derive insight out of that data for the financial community. But what we're going to talk about today is a little bit more, I guess, broad in terms of early warning signals. So some of you may not know IHS Markit so well, but we're effectively a data, insight, and analytics provider across three broad industry sectors, which is resources, transportation, and financial services. Beneath those broad areas, we have a variety of different data, around about 1,500 distinct data products or data services. And you know, from our perspective, one of the challenges is how do we make that make sense just to us internally, and then obviously ultimately to our clients that use our data. So whether it's data that talks about economic and country risk, whether it's kind of automotive data, talking about electronic vehicles, or climate data, or you know, fossil fuel related data, how do you bring that together? What we've developed in the last few years is the IHS Markit Data Lake, which really I think is an important foundation of thinking about early warning signals. Because one of the key ingredients to derive early warning signals, whether you're sitting in a data provider such as IHS Markit or your own institution, is bringing that data, integrating it into a single place to make it relatable and referenceable, and you can cross-reference that data. So the IHS Markit Data Lake allows us to do that. It's taken us a while to bring all this data into one place, but really is a key foundation of making that data available, cataloging it, making it searchable, and making it referenceable, and making it relatable in the right context. Because clearly, you know, very different data when you're talking about you know, the financial services world versus some of the real economy data that we capture. We sit at an interesting kind of juncture of the market as we sit on those big three industrial kind of sector data sets across transportation, resources, and financial markets. We very clearly see the close linkage between the real economy and the real economy data that's available, and how that flows into financial markets, and how people within financial markets can use that. A lot of the data that we have within our resources and transportation sectors, historically, if we go back a number of years, hasn't been extensively used by the financial world. In recent years, we've been trying to change that, and really by bringing this data together within this data lake foundation, we're putting ourselves in a position to derive insight from that real economy data and how it flows into companies within the financial markets that are being invested in, or as part of more broad risk and opportunity assessment. When we think about early warning signals, I kind of start by thinking about the business problem that we're trying to solve. And typically, when you're thinking about early warning signals, you're looking at processes within banks, such as credit risk assessment. Within the investor community, you're looking at investment opportunities. Or within your existing portfolio, you're looking at investment risks. What risks are within my portfolio that I need to be actively be aware of and managing? That said, I think it's important to stress that the way I think about this is within a framework of country, sector, company. So there's different levels of data and different levels of signals that will be relevant at a country level, at a sector level, and then it's an idiosyncratic company level, which you may be invested in, the security of that company, for example. But all of these things are linked by kind of trigger events, particularly on the risk side of the equation. So I've listed out a few example trigger events. So if we choose one, I'll choose Australia, China, trade tensions at the bottom of the list. Within the last 12 months, there's been significant political tension between those two countries. That's had impact on commodity prices, specifically things around impacts around iron ore, as well as coal. And really, there's two sides of the equation. One, there's the rhetoric and the political or geopolitical tension that exists. And then there's a second, what is the actual impact of that tension onto the actual trade flows of these commodities? And what do those trade flows actually mean? Is it having an impact of the underlying commodity price? And what's the downstream impact of that commodity price to companies that are highly, or share prices highly correlated to said commodity? So we have a service which is called Commodities at Sea, which is a real-time tracking service which looks at all the vessels on the ocean, around about 130,000 vessels, going through 16,000 ports and terminals, which references about 250,000 companies. And we really understand where that vessel is, what is on that vessel in terms of cargo, whether it's crude oil, whether it's iron ore, coal, dry bulk, and understanding the value of that, but also understanding where it's flowing to and from. So digging a little deeper on the next slide. Excuse me, jumped to one too many. So this is a quick screenshot of our Commodities at Sea dashboard that shows the physical trade flows of those ships. As I say, we've got real-time data. We get information every 60 seconds or so. So you can really understand where you're seeing those raw commodities move from one port to the next, which commodities are maybe sitting off port in floating storage. So, for example, crude oil sitting off the port of Singapore in floating storage can have impacts to crude oil pricing. And also, other trigger events that we haven't mentioned yet, such as the Suez Canal blockage in March, which obviously had specific impact on the vessels that were due to be traveling on that route, but also had broader implications to commodity pricing because of roughly 12% of global trade going through the Suez Canal. So this kind of very detailed data can then be aggregated in different ways to derive insight, whether that insight and your interest is specific to commodity pricing and supply and demand and how that physical trade flow will impact on those commodity prices, or whether your interest is more on the companies that are heavily correlated or highly correlated to those physical commodities. This type of data gives you that insight to be able to understand how the flows are progressing from port to port, how things are moving, whether there's geopolitical tension, which can provide early warning signals into the opportunities and risks around particular investments that you may have. A different example of an early warning signal that I'll also touch on is in the FX market. So we're also working to develop an early warning indicator for the FX market, and we're really focused here on signaling substantial exchange rate movement, which will allow the users of this service, be those corporates, banks, asset owners, asset managers, to firstly identify there's a risk with a specific currency, monitor that risk over the coming days, and then put into place mitigating hedging strategies, which will allow for trading and for managing that particular risk that's been identified. The way in which we've approached this is really, the back testing that we've done here. What we've done is isolated big absolute movements in currency rates, as you can see in the top chart. The grey blocks represent what we define as significant movements. We then look to overlay the methodology that we've developed with our FX risk indicators to see what predictive power that index has on the underlying FX rate. So if we move to this next slide, you can see on the top portion, there's a kind of multicolored traffic light line, which represents the risk, the FX risk index. The higher the score, I guess the more close to red, the bigger the risk. And as you can see from the grey bars and the red indication on the risk index, we have a kind of predictive power or a risk signal that there will be an FX or a significant FX movement in this particular currency. So that's something that we've been working on. As I say, we've back tested over the last 5 years. We've seen some really positive results on that. This is not meant as a risk. This is not meant as an FX prediction tool. It's meant as a risk indicator to allow people to understand where there's potential risk, where they have exposure to a particular currency. In this case, it's Brazilian real. In terms of how we've approached this, so as I mentioned earlier, we've built a foundation within our data lake, which allows us to integrate different data sets across our entire data sets of those 1,500 or so different data assets. In this particular score, what we've done is combined our country risk data, where we have analysts focused on 211 companies providing risk scores around government stability or instability, policy, and scoring those individual countries. We combine that with banking risk scores. We also combine that with an economic indicator that we produce called the Purchasing Managers Indices, where we survey companies to understand the momentum in different sectors in different countries, as well as inflation and exchange rate forecasting. And that allows us to derive a risk index. And then we effectively calibrate those raw risk inputs, looking at momentum, and then that allows us to provide a risk score or a risk indicator, which is an early warning signal for significant or substantial FX movements in a particular currency. So a lot of work that we've kind of done to kind of focus on what is a challenging market in terms of FX and providing those risk kind of indicators. So in summary, what I wanted to do in a few minutes is just kind of take you through how we've approached bringing a vast array of data together within our data lake. That allows you to have that integration and gives you a foundation to then start deriving insight. There's very different ways in which you can take that. The combination of that real economy data into financial services is something that we feel has a strong early warning signal capability and potential, and we've proved that with Commodities at Sea and other solutions, as well as obviously specific data within the FX rates market that I've just touched on. So hopefully that gives some useful overview and insight and some good, I guess, a good place to start the panel discussion. So maybe I'll hand back to Andrew and we can go from there.
Great. Thanks so much for that, Ross. So I want to jump straight in then. So we've heard there some specific ways that data can be applied and used. Tim, let me start with you and then Desmond as the two investors on the panel, although I realise you come from slightly different aspects, but ultimately you're both looking to use and apply data. Within each of your organisations, to what extent have you adapted and are you adapting your approach to how you apply and use data to assess the landscape and the various opportunities as we emerge from the pandemic? So, Tim.
Sure, thanks, Andrew. Yeah, look, it's quite an interesting one, and thanks, Ross, for setting the scene from a data perspective. I guess from an asset owner's perspective, we've obviously got quite a diverse investment focus. So I sort of set about thinking what might be interesting to share from that perspective. And I guess there's a couple of things that we've sort of seen shifting around, and it's partly cyclical and it's probably partly COVID driven. But some of the things that I thought were possibly interesting was, so from an investment strategy perspective, economically, I guess this ties to some of the data that Ross is talking to. You're sort of seeing more of a influence from a fiscal perspective, than a monetary perspective at the moment, and that's certainly changed over the last little while. So there's a focus that's flipped there as we try to understand what's going on in the economy. From a financing perspective, particularly from a private equity perspective, private into public, I suppose the availability of capital, interest rates have fed into the dynamic we're seeing around SPACs. So that's certainly an interesting one from an exit perspective for private equity and for new listings in a public equity space in my space, which don't follow the traditional kind of I suppose process from a listing perspective. So that's something that's changed and different for us to try and assess. Something that ties quite interestingly into what Ross was talking about is from an ESG perspective, certainly comes across my fundamental equities research as well, is supply chains. And so there's a couple of things going on there which we think are interesting. One, again, as Ross talked to from a commodity perspective in terms of inflation, inflation being more interesting to us than the commodities themselves, but that's certainly one dynamic that we've observed as sort of being interesting coming out of the pandemic, and one that we're monitoring closely. And you just have to bring up a chart of copper price. Ross mentioned iron ore, lumber price is another one that very, very interesting dynamics. But from an ESG perspective specifically, the other point I thought might be interesting is around modern slavery, and that's become a bigger focus for us in Australia, and I know has been an acute focus in places like the UK for a while. So those are some sort of broad headline topics, and I guess a couple of last ones from a fundamental equities perspective. The availability of real-time data seems to have stepped up through the course of the last year or two, particularly the advent of COVID, talking to mobility data and the like. It's certainly something that we've spent more time on as a result, trying to learn, again, as Ross was talking to, trying to take this data and turn it into actionable insights is perhaps the challenge, trying to work out whether it's something that's valuable, whether it's tactical, whether it's structural. So, and that's led us on to spending more time in terms of assessing web traffic, app traffic, and those sorts of things as we tie that back to our fundamental research. So I guess from a headline, at a headline level, Andrew, that's some of the things we've been thinking about.
That's great. Thanks, Tim. Desmond, how about from your perspective?
Well, this very good questions. It's also very broad questions. I mean, from like asset managers and investment managers perspective, I guess we always need to adapt our models, because the biggest problem for us when using data is all the data are pretty much backward-looking with a very limited history. So for the case like COVID, right, we absolutely have no data before. And given what has happened, right, the speed of the lockdown, the economic contractions is something we have not seen before, right? And so what's the amount of liquidities and the speed of economic recovery right now? So, I mean, the numbers are really outrageous, right? Right now we have 3 trillion, so liquidity in central bank, interest rate 0%, US market valuation, historical high, right? 23 times PEs. So I guess it's always very challenging, and to some extent it's actually pretty dangerous to just stick to the old data or old models without adaptations. Because if you just stick to the old data or the old models, you can be completely wrong and miss out the whole bull market last year and right now. So I guess flexibility is what we focus on. In Cornings, we have a team of specialists in investment solutions who has been building, monitoring, and revising our tactical asset allocation models with the correct data, the right data, the appropriate weightings, and also make sure, which is I think is important, the source and the quality of data inconsistent over time. And what is, again, from an investment manager perspective, what is really important is to combine the fundamental the investment teams with the quantitative teams. So we have the fundamental expertise and experience to understand the data and adjust the data before we really use it. One good example is like liquidity, right? In the past, where we actually noticed there might be inflows to the U.S. market, a lot of the time the U.S. market will correct, the week after. But the situation is totally changed now, right? Because we have a historic inflow of liquidity and central banks' liquidity creations. So right now, rather than be a contrary indicators from liquidities, you probably just follow the liquidity for now. Another examples I would highlight is like the investment sentiment and positions. Right now, I would guess, right, the positioning in risk on and equity is very consensus and to some extent very extreme. And again, right, in the past, those would be like warning signals that the market is approaching the peak. But again, when using the data, you also have to understand the cycles that we are in right now, which normally the investment sentiment has to switch from extreme bearish to extreme bullish in the very early phase of the economic cycles, which we are going through right now. So again, be flexible and be adaptive, the data, and also talk to both the quantitative and fundamentals. Investment teams and expertise would add a lot of values to our clients.
Great, thanks for that, Desmond. Andy, Desmond has raised some points, and they've also mentioned earlier in the discussion about obviously these inevitable challenges that exist in making raw data mean enough to be implementable within investment strategies and portfolios. How does that get achieved?
Yes, absolutely. I mean, that's what the earlier discussion actually alluded to in terms of looking at raw data, how you actually make it implementable. So for fintech, there's always a thing in a tech. In the financial markets, often enough people say we have a large amount of data and big data. But actually, no. Financial industry, we're looking at a huge amount of regime shifts in the markets itself. Sometimes it can be simple as market liquidity regime shift. Could be central bank policy changes, but it could be also geopolitical changes, events, and also COVID, which is once in 100 years sort of event. So that makes all the big data not usable in terms of having a consistent structure in the data itself. So often you have to chop the data into smaller pieces in order to capture the particular events you want to capture. So that's what Desmond was just alluded to as well. So we have a small data issue in terms of financial industry. So that's one of the challenges, to come up with new data sets for unstructured data. That's what we do often enough. From a tech perspective, are you looking at an implementation issue, which is mainly in the data slippage? So data slippage comes from all kinds of places. It could be just missing data points in a time series. It could be even a surge in coverage in news articles. And it could be as simple as just a wrong data input by the data vendor. So all those actually contributed to a quick deterioration in the performance matrix that you think in your perfect world when you model data itself that it should work and work in certain ways, but it breaks down as quickly. So that's an issue that we need to solve even before looking at the data itself. We're looking at data ingestion layer as robust as possible. You need to have a data structure which is solid, infrastructure in terms of computational infrastructure. Those things will safeguard whatever your modeling effort, coming out of the data that you're looking at. So from these two perspectives, I mean, we struggle quite a bit of it, considering that, I know IHS Markit has a huge trove of data, and we're sitting on top of a large data sets as well, with the use of AWS storage, the largest one in terms of B2B data. And we're only scratching the mere surface of it. And we constantly grappling with these two challenges in terms of implementation.
Thank you. That brings us nicely onto the first polling question I'd like to ask for all of you in the audience. So, Ross, I'm going to come to you in a moment, but just before I do, we're keen to get your thoughts in the audience on what you see as the biggest challenge in using data for the purposes of investing. So on the screen, there should be a question and 4 options. So what's the biggest challenge? So is it trusting the source of the data? Is it defining it consistently, even internally for you to be able to then act on it? Is it the ability to consolidate and collate it? Or just simply make sense of it, given there's so much of it? So if you'd be kind enough just to share your thoughts, I know that would be of interest to our speakers, certainly. And Ross, while they do respond, are there any sort of silver bullets in solving this challenge?
Silver bullets is maybe a bit of an overstretch. I think certainly there's some kind of core principles of moving from kind of more traditional approach to data to kind of what I believe is required now and in the future. And a lot of that I kind of touched on briefly when I spoke earlier. But such things as bringing the data out of the silos within an organization into an enterprise type approach to data, and making that data referenceable, searchable, so you can start to commingle it and combine it, I think is the starting point of the journey that you need to do. I think Andy mentioned earlier that is quite quickly said, quite long in the making of actually bringing that data sets together, particularly when you think about mapping. If you've got a multi-asset exposure, you're mapping securities in the bond market, the equities market, back to underlying companies. You've got corporate hierarchies, ultimate parents. You've got to map through that corporate structure to make the data relevant. And that's just in the financial market side. But then particularly when you start to incorporate real-world economy data, that's not necessarily collated and gathered in the same way as the financial markets want to consume it. So, the challenge that we've been through of developing the data lake and bringing, all of those 1,500 different data sets together across real economy and financial services is, by no means an insubstantial challenge. It's a multi-year project, and getting that foundation right, I think, is the important point, because then if you've got the foundations right, you can onboard new data sources, assess the validity or the trust that you have in that source, and then choose to use it or not, depending upon its merits. But without that foundation, it's difficult to assess new data sources, be them traditional or alternative, in a quick, timely manner. And ultimately, what you're trying to do is reduce the amount of time that you take to assess whether data is useful and get to a quicker point where you can make a decision, because, as has been mentioned a couple of times, the amount of data and the speed of data is increasing, and therefore you want to be able to get to a decision quicker. And that foundation, I think, is the key point, at least in my mind. So, in answer to the survey question, I think I would probably be edging around 3 or 4, consolidating or making best use of it.
Let's see if people are on the same wavelength. Having a quick look at the results of the survey. It'll take a second to pop up. Yes, they've gone at least for the making sense of it. Is that almost 2/3 seems to be the biggest issue. That's obviously interesting. So even as a starting point, being able to do that is the challenge. So thanks for that. I've got a couple other questions we're going to ask you shortly. So actually, maybe just to take a slight step back, with the whole focus of this discussion is really on identifying early warning signals. Early, though, Andy, I'm keen to get your thought on this, is subjective. I mean, it's clearly different types of investors have different timeframes and around different strategies. So in trying to analyze and provide data in usable, implementable ways, how do you deal with this?
Yeah, indeed. I mean, early is indeed subjective. So at Bluefire, we try to stretch it to 6 to 12 months because we believe that's where our clients, mostly asset managers and risk managers, are looking at. So we're pushing that further away from execution layer. So we meet challenges, obviously, because once you push the intelligence representation to such a length, it requires two things. So first thing is, again, data. Because once you go into that sort of length, you encounter a lot of low-frequency data sets, which, by definition is sparse and not really desirable in terms of using more advanced machine learning techniques. So that's one thing. And the other thing is, as I said earlier, so we're trying to sort of mimic systemizing a human decision-making from an investor perspective. So the math of that is not existent. So we need to invent some of the math. So the key part of it is looking at the data itself exactly the same way as the investor ingests information in a natural flow. So they look at different data sets. Some are monthly, some are quarterly, some on a daily basis when they read newspapers or occasionally watching a TV show. So we need to ingest all the data sets the same fashion as the investor or human does. So that creates that math problem. How do we actually combine all the data sets? We know that the deep learning technique excels in these tasks, but that requires a large amount of domain knowledge transfer, which is itself a challenge. So that's how we actually frame the early warning signal in Bluefire.
Great, thank you. So Desmond, from a practical investment perspective, as you look to try and identify and interpret early warning signals for the whatever markets and assets you're focused on, do you look at it as it being usable for risk on or risk off trades, and how does it differ in terms of how you use it for each?
Well, it's not easy, right? We want to be early, but we don't want to be too early, and absolutely we don't want to be late, right? So in Cornings, right, as I mentioned, our investment solution teams has a tactical asset allocation models and a systematic macro models, which give us figures every week to detect the risk on and risk off signals. And for us, the quality of the data is more important than the quantity. I think that's pretty much in line with the question you asked, Paul, how we actually use those data and what data to use. So we actually screen out a lot of the data and only use those which are have high statistical significant predictive powers. And we classify those data into basically a few categories: the growth, inflation, liquidity, and policies, which I think will have the most impact on the market and investments. And definitely we have to calibrate the weightings on those different factors, which is also an art. And those weightings would keep on changing depending on the market cycles. And some of those figures, as I mentioned, right, sometimes we use them as like trend followings, and sometimes we actually use them as contrarian figures. But again, even those follow-on or contrarian factors can change over time. Or to simplify, our systematic macro models is pretty much like driving a car. So on one hand, we have these factors which teach us whether we should move the gear on and 1, 2, 3, 4, 5. And at the same time, we also look at some of the other volatility factors, the stock market volatility, the FX movements, and the VIX to gauge actually how much risk we should step on the gas pedals. So definitely it is pretty much an art. And again, I would like to highlight that we definitely cannot rule out the fundamental impact of how we use the data. A lot of the times, for investment and for fund managers, the gut feeling, is pretty much something you should rely on as well, because those are experienced, which is telling you something might be wrong rather than just rely on data.
Great, thank you. Tim, anything to add from your perspective?
Yeah, I think it's maybe the nuance for us from a fundamental equity research perspective. Trying to work out the effectiveness of something that you've learned early. I was trying to think about a couple of examples recently that would tie this together. And I think from the fundamentally we try and piece together small bits of information, mosaic theory, triangulation, to really try and work out whether we think something's valuable, whether it might be tactical, might be structural. Some of the things we saw through COVID, one of the things that really stood out initially was, real-time data was showing us from a mobility perspective an auto preference, a really, really strong auto preference, as in doing away with public transport, far preferring personal transport. And from that perspective, we're able to triangulate that through a couple of our exposures and really understand that this was certainly a tactical theme, an important piece of data and information, and it's actually proved, probably longer in the tooth than we would have expected, and bordering on somewhat structural. I think another interesting example would be to look at housing, and this is a global phenomenon now, that with the advent of COVID, it looks like there's at least half of us are calling in here from home rather than sitting on a stage in Hong Kong, as it might be 2 years ago. So the nature of housing is somewhat different in terms of where we can all live. Again, seeing that through the shift in property prices in non-metro areas early last year was again a really interesting sort of piece of data that has supported a view of that we've adopted in terms of housing. And we mentioned some of the commodities, lumber particularly, and so we've seen that play out. But I think that's probably it's certainly a task that aligns with what Desmond was saying around the changing nature of the data and its usability over time. But we try to obviously monitor on an ongoing basis, but tie that from an investment perspective to a thesis as such on a particular company, rather than just trust it forever. So, some additional thoughts from my perspective, Andrew.
Great, thank you for that. Just conscious we haven't had we had one or two questions come through, but please send through questions if you have them for any of the speakers, and obviously therefore we can ask them issues that are front of mind for you. For now though, let's move to a second poll quickly. So this second poll for you in the audience is really to, if you'd like, understand the importance of data for listed versus alternative assets, especially given the greater appetite for alternatives amid this sort of yield drought that everyone's facing. So on the screen, there'll be a question for you that comes up. For which of the following assets is it most important for you to have more data to support your investment decisions? And you've got 5 options there. The first obviously being public securities, and then the other 4 being different types of alternative, less liquid assets. So Ross, as the audience votes, with your perspective with a sort of data hat on, how do you see demand evolving by asset class?
Yeah, it's an interesting question. I guess I would see 3 kind of big trends. One you've kind of alluded to already, the shift from public to private markets, and therefore the demand for data in has traditionally been a very opaque market, presents a number of challenges to participants that are either new entrants into that market or looking to diversify their private market exposure. Let's say they've traditionally been a private equity player and they want to get into infra. They need to source a very disparate data in that space. So I think that kind of focus on more depth of data within the private markets is definitely one large trend that we see. I would say the second we've touched on as well earlier in the discussion is the increasing need for both the financial and the non-financial data, so things like ESG, and that really transcends both the public and the private markets, that there is a need to kind of capture that non-financial data alongside financials. Financials is already challenging within the private space. Adding non-financials is even more challenging. So I see that the timeliness and that combination of financial, non-financial data is a really important aspect. And then finally, I touched on earlier that the use of real-world data or alternative data, if you prefer, and how that impacts onto either your public or your private exposure. So those would be the big 3 trends that I would discuss and think about. the question is always, how do you manage all of that data in one place? Obviously public and private equity has very close correlations when you're looking at valuations. Typically people have managed that all in silos within institutions. We're seeing a trend where people are trying to bring that all together and manage it in one place. And that's also something from the management of data perspective, which is maybe slightly beyond what you asked, but they're just worth maybe commenting.
Great, thank you. You're 1 for 1 in predicting correctly the audience vote. So what's your prediction here?
I'll go private equity.
Right, so let's bring up the results so we can see if Ross is on a roll. So while we bring up the results, I'm keen to get a sense from, I guess, from Tim first. There's obviously so many new data points becoming readily available. You announced, there we go. Thanks for the results. So private equity wins it. Great. So there's so many. You mentioned housing as one example of many. How do you determine what is now valuable from actually the perspective of how you choose to act on it to invest, compared with what is just more data to add to this mass that exists?
I think, I think that the comment earlier around it being partly an art is probably apt to answer that question, Andrew. I think the way we try to ingest this data is initially trying to find the right vendor and trying to work out how it might fit in with our process, which primarily involves talking to people and understanding how things work. I guess change is something that's really, really important in terms of the way we see the world. Change generally means that there's an opportunity around the corner. It can often take quite some time for that to evolve. So really, I think I'd just reiterate the triangulation point that I made earlier, really around the way we try to add little pieces of data together in terms of a mosaic theory of sorts to really give us confidence and conviction around the view that we might have. Often what we're doing is adding layers of information to a position we have already adopted, as in, we've taken a view around the thesis of a particular, the outlook for a particular industry and company, and does this piece of information support this or challenge this? And that can be perhaps an easier way to act on information rather than just having an initial single data point. It's much easier to obviously add it to a string. It goes to an earlier comment around the length of data sets. I think that's important as well. So I guess a couple of thoughts there, if that's valuable.
Great, thank you. Andy, from your perspective, you've talked about some ideas already in terms of overcoming some of the challenges in collection and use of data. Is there anything in particular that's needed to advance how data is curated and linked together in the way that Tim's saying he likes to use it?
I think for us, the insights really means are really possible with scale. Because if you think about scale, it's not just a unit cost of production of intelligence in the investment process. It also means the ability to actually contextualize the intelligence harvested from different data sets. If you look at normal asset managers, they're looking at most 1,000 companies, the bigger ones, 1,000 companies in that, with the help of sell side. The sell side, the biggest, is looking at a couple of thousands of companies in terms of coverage. So for us, being able to look at 10,000 companies on a daily basis, give us that context, in terms of defining the behavior of a particular market, a particular industry, and a particular life cycle that the company is actually in. So that's, to us, is valuable. In terms of putting that investment decision into a perspective, essentially.
Great, thank you. I know we're approaching the end of this session. I have got a couple more questions for you on the panel. I'd first like to just quickly ask a third question, which I think will lead to some interesting comments from our speakers. So the final poll question for you in the audience is going to ask who should lead the data analysis and application efforts internally. So you've got 5 options there. There obviously could be others, but just from these 5, which team effectively do you think is best placed to lead those efforts? And Desmond, while the audience thinks and votes, I'd like to get your thoughts on ultimately how you as an asset manager, as an example, or how investors more broadly, in your opinion, should look to ultimately manage the data process, collecting it, curating it, analyzing it, to ensure that it's meaningful.
Well, I don't really have a clear answer to that, but for data, as I mentioned, the source and the quality of the data is very important. So just to make sure not garbage in, garbage out, make sure we know the changes of the data underneath it, and when those changes happen and why those changes happen. Are we going to still continue to use those data, and make sure those data would still have enough predictive power as before. And equally as important, as I keep on mentioning, add a human touch factors on it, be fundamentals rather than just pure fundamentals or quantitative. And again, when we're actually using the data, do this as a very research project, without a result in mind. Just go through the data and see what the implications, and then find the implications from those data.
Great, thank you very much. Tim, just very briefly, is there anything that you at Where Super do which you think is best practice, if you like?
Yeah, I'm not sure whether it's best practice or not, but I think it's my sense is that this is a layered, there's sort of a layered approach here. So it's just from a relevance perspective, I think it's assessing that, is this piece of information relevant at the CIO level? Is it relevant at investment strategy level? Is it relevant for an individual portfolio manager or research analyst? And so that I think it probably differs. So it's a challenging one. It could be quite complex. And it's really just trying to have that the allocation, appropriate allocation, I think, set. So yeah, somewhat challenging question.
No, fair enough. Ross, less challenging question. What do you think the answer is going to be?
Well, I'll go for PMs in this one.
Great. So let's if we can reveal the results, please. Right, nearly. But that's interesting. So there's obviously a complete difference of opinion around who should ultimately take charge of the data. So there's still a lot of work to be done internally at a lot of organisations to iron out these issues and make it consistent. So thank you. So we're right towards the end. I've got a question that I'd like each of you to give me an answer to. Unfortunately, Ross, it's going to get harder for you because you're going to be last and you're going to have to find something new to say. So Desmond, I'm going to start with you. If you can just give 30-second view on the following, and each of you can follow. So we've talked about lots of different issues, lots of challenges, lots of ideal scenarios, if you like, for investment data and how to use it and make it meaningful. So what would you most like to see? What's the single thing you'd most like to see change in terms of how investors apply data to make more, whether it's more accurate or more value-add, meaningful investment decisions going forward?
Okay, well, right now, our tactical asset allocation models in Cornings are using a lot of traditional data. And given we have a lot of new source of alternative data, I would love to see how we can implement those alternative data into our traditional asset allocation models. For example, like Google Trends, traders mentions, or the NLP, they actually will save a lot of time and give you different insights in addition to the traditional data.
Great, thank you. Tim.
Yeah, I think from my perspective, I'll go back to the point that I raised earlier, which was just the acceleration in the adoption of technology broadly is really forcing us as analysts to continue, as analysts and research people, to continue to hunt down different sources and apply those as appropriately we can in terms of use cases, because I think that is really something that's an outworking of that technology adoption, is just the availability of data it changes rapidly, and so our ability to work out what's relevant, what's not, and bring on new use cases and apply those appropriately as and when is probably an emerging skill that we need to evolve.
Thank you. Andy, what are your thoughts?
Yeah, I think the poll itself is just embodies, there's no certain path, and in terms of how do you use data, who's using data in the investment community. But overall, what we have noticed is that human resistance to change routine, daily work process. But then again, we've been setting our shorts for the past 12 months, so I think we just need to do it at some point in time.
Great. And Ross, closing comments to you.
Yeah, I pick up on a couple of the comments that have been made, and something I mentioned earlier. It's really, for me, about getting the foundations right. We work with lots of different types of clients that source data, have it in different parts of their organization, sitting in silos and aren't really looking at it on an enterprise level. So I would say, the one thing that I'd like to see change is people to adopt a more enterprise type approach to data. Once you've got it in a single place, and you can then start to cross-reference it and deliver it into different parts of the organization, you then have a lot more power. And I think that allows you to assess the quality of the data you're using and then derive insights. So for me, that getting the foundations right is what I'd like to see over the next little while. And then that will allow the investor community to make better decisions because they've got out of silos and they've gone into an integrated model.
That's great. Thank you. Thank you so much to each of you. Obviously, it's been a relatively short discussion for such a big topic, but you've delivered lots and lots of insights. So hopefully in the audience, you've got some good practical takeaways. Thank you all for your time in speaking. Thanks so much for joining us in the audience. Of course, thanks again to IHS Markit for the co-hosting and the support for this session. As mentioned before, there will be a webinar, on-demand version of the webinar for you to review. And of course, we'd love to hear any feedback from you. So for now, hope you have a great rest of your day, and we'll look forward to seeing you again soon with a new session. Thank you.